Bismillahirrahmanirrahim. So this is a very important survey by Barbaras and Thaler, which explains the basic concepts of behavioral finance. So we will be studying simultaneously the classical theory of rational behavior in markets, which I think is, if not due to Fama, Eugene Fama is a very strong contributor to the development of the theory of rational markets, which basically describes how an ideal investor should behave. So it is actually a normative theory. However, standard confusion in economics, they present a normative theory and then they say this is a positive theory, which is ridiculous. I mean, they should say, okay, this is how people should behave and let's look at how people do behave. But they don't. They say, okay, this is rational behavior and by axiom, everyone is automatically rational. So if they find behavior that seems irrational, then they have to find a different model which makes that irrational behavior rational. Because ideologically, they cannot accept the idea that human beings may behave irrationally. Now, if they had ever looked into their own hearts, they would have seen immediately that this is a ridiculous assumption. So anyway, so what we are going to do is to explain to you the standard theory, why it fails, and then explain how behavioral finance explains that failure. So there are, again, just like the last lecture on camera, this is similar. Alright, so traditional finance theory. We want to understand financial markets using models in which agents are rational. This is assumed a priori in advance. This is not subject to debate or discussion. So all models have. So if there is a contradiction between what the observed behavior and the model, you modify the model to in such a way that agents remain rational. I mean, you cannot relax the assumption that agents might behave in a different way. So, rationality involves one, having all information and processing it correctly, and then there is the question of how you update information. So, that has to be done according to the Bayes law, which we will discuss shortly. So basically, you see, unlike the theory which you have studied, this is normally a part of an advanced macro course, that the theory of rational decision making under uncertainty. So there are two types of theories. There is the expected utility theory, which I have studied, and the SEU, the subjective expected utility theory. So the difference between these two is that in expected utility, the probabilities of all the events are known in advance. So then you can calculate expected utilities. For example, suppose it's going to rain tomorrow with probability 30% and not rain tomorrow with 70%, then you can calculate expected values. But what if, as is normal, you don't know the probabilities? Then you can't use expected utility theories. So then there is an extension of this theory which is called subjective expected utility, and which it is shown using arguments which are actually fallacious, and I have proven that they are fallacious somewhere else, but nonetheless they are widely believed today. These arguments show that rational behavior requires that first you assign some subjective probabilities to these events. So even though you don't know what the probability of rain is, in order to behave rationally, you have to have some probability. You have to think, I mean, this is, okay, so you have to imagine, maybe the probability is 35%. So that's your subjective probability. It may vary from person to person, but for rational behavior, every person has to have subjective probabilities. I have a whole lecture on what this argument is and why it is wrong. Did I do that last semester? I'm not sure, but anyway, it's available. I will give a link to that. So basically, once you have subjective probabilities, then the problem reduces to the same expected utility as before. The only difference is that instead of having objective probabilities, which are like if you flip a coin, the probability of heads is 1/2. So that's an objective probability because everybody has the same probability. But when events are uncertain, so they don't have known probabilities, then again you first assign them probabilities so that subjective probabilities become known, and then you convert this to an expected utility problem. So that's called the SEU. So basically, rational behavior involves a very large number of assumptions about the information processing ability of human beings, which happen to be false. But basically that is the prevailing theory. Actually, it's very strange. I mean, the theory that is currently being taught all over the world is mad, and it's a crazy theory. We will discuss why this is so crazy, and yet it is widely believed. So it's very easy to explain why it is wrong, and it's very easy to develop a better theory, and it's already been done. But still, this crazy theory continues to be taught and believed, and even this survey and the Barbaras-Taylor paper, they take as the reference point the dominant theory, which is the EU and SEU theory, and they explain why in some places it conflicts. And so the response to this among the orthodoxy is that yes, we have a few places where our theory doesn't actually match the observed behavior, and we are working on it, and they are devising new models, more complicated model, where in order to save the axiom of rationality, so they make the environment complicated. They say, okay, let's consider different types of information structures, different this, that, and the other. Everything is allowed in order to create a model in which rational behavior occurs and the observations match. Underlying this problem, this is the Friedman as-if methodology. Friedman says you can make any assumption you like as long as the results match. But now they make ridiculous assumptions about human behavior, and they say, okay, it doesn't really matter. I mean, everybody agrees that these are ridiculous assumptions, but it doesn't matter what assumptions I make. The only thing which matters is that there should be a match in the end. So when you are allowed to make ridiculous assumptions, then you can create a match by choosing the right set of assumptions. The question that are these ridiculous assumptions about human beings true of human behavior, this question is not allowed to be asked. And so when you don't allow this question, because by assumption human beings are rational, then you have automatically blocked access to the truth. It's impossible to get there. And that's where economics as a profession is today. That's really very strange. It's like crazy people have taken over, and they are teaching crazy theories, and everywhere, not just Europe and USA, in Pakistan these theories are being taught. And then people have great difficulty understanding these theories because the theories are crazy. But people teach them, and you study them, and you pass comprehensive based on these and everything. Alright, so here's the Bayes rule. So I'm going to ask you this question, a chocolate for the right answer. So probability that a woman at age 40 has breast cancer is 1%. So basically, out of 100 women, 1 woman will have this disease. Now you can do a test which is called mammography. The probability of when you do this test, the test says that whether or not cancer is there. So the probability of a false positive is around 10%. That means the test is correct 90% of the time. So if it gives you a result that is that says that the woman has cancer, then 90% of the time the test will be right, and 10% of the time test will be wrong. So if a woman of age 40 is tested as positive, what is the probability that she does have breast cancer? So this is the question. And the right answer to this question requires using the Bayes rule. But before we explain what the Bayes rule is, I would like you to think intuitively about this question and give me an answer. What is this probability? Well, intuitively it seems like it should be 90% because that's what the test says. But there is a problem with that. I guess the best way to do it is to look at this next diagram. Actually, the probability that she has breast cancer is only 7.8%. And that is made clear by the Bayes calculation is on the left-hand side, and that's very difficult to understand given how human beings don't use Bayes rule like that. But the natural frequencies makes it easy to understand. First of all, you start with 10,000 people in the population. 100 of them have breast cancer and 9,900 don't. This is what it means to say that 99% probability. Now you test every single one of them. So in the 100 people, you get 80 people who test positively and 20 people. So this is the probability of detection is 80% and 20% test negatively. And so of the 100, 80% are detected and 20% are not detected. Now, of the no breast cancer people, 8,950 test negatively, and there are false positives of 10%, 950. So if you look at all of so suppose that every 100% is tested. So how many people had a positive test? Well, there are 950 from the no breast cancer side and 80 from the yes breast cancer side. So of these 950 plus 80, meaning 1,030 people who tested, 1,030 women who tested positively, only 80 of them have breast cancer. So the total probability is 80 over 80 plus 950. It's very simple. This is the Bayes rule, in fact. So the problem here is that even though the test is 90% accurate, there is something which is called the base rate. The base rate is the occurrence rate in the population itself. So the occurrence rate, when the occurrence rate is in population is very low, then you see, suppose you have a woman who has tested positively. There are two possibilities. One possibility is that she doesn't have cancer, and the test is wrong. And the other possibility, she does have cancer and the test is right. Now the case, the probability of not having cancer is so huge that this is the base rate, so that even though the other probability is small, still the total occurrence of the case where woman doesn't have cancer and tests positively, this is a very largely occurring case, and the woman really having cancer and the test being right is a low occurrence case. So these two probabilities have to be compared. So the first one is ignored because by most people. So this base rate, so actually naturally people make this mistake. This just shows that people are not very rational in the sense of being able to make complicated calculations, contrary to the economist's assumption. So now the thing is that doctors, one of the standard defense of this by economists, when economists are shown that, look, people behave irrationally, They say, oh, well, that's because they don't have experience. You put them in an experiment and you have these fresh students, they have never seen this. Now if you take real experienced people, then they won't make this mistake. So they did this on doctors who have, every day they are analyzing tests and prescribing medicines, and you find that 95% of the doctors estimate this probability incorrectly, to be 10 times as large as it really is. So what's the solution? The solution is to have a second test, and as long as they are independent, so you can reduce the accuracy rate from 10% is too high given this base rate. It's not going to give you a good detection. So if you can get two independent results, then the accuracy of detection will be reduced to 1%, and then you get closer match. So anyway, the point here is that people are not very good at making calculations about optimal decisions under uncertainty. They are not very good at making inference about uncertainty. So the model of rational behavior itself is deeply flawed. I mean, our models, the French models, which assume that people have supernatural ability to compute and exactly find out what is happening in uncertain situations, but the empirical evidence is against this assumption. So behavioral finance is a new approach. It has emerged at least in part due to difficulties faced by the traditional. So when you start with this fixed idea that people are behaving rationally, and then you look at actually what happens in the stock market, then you have to give up one of the two assumptions. Either the stock market behavior is irrational, or the people are not rational. So basically behavioral finance allows people to behave irrationally. This is something that conventional finance theories do not allow. They can allow anything. You can make any kind of assumption you like, but you cannot make the assumption that people behave irrationally. So you see, because the orthodox finance think is the dominant paradigm, everywhere it is still being taught, even though it's so strongly rejected by the data, it's unbelievable, that here even the phraseology is defensive one. It says that it argues that some financial phenomena can be better understood by using models in which agents are not fully rational. This is just basically because behavioral finance is a minority view still, and so they are being very defensive. Actually, what we can say is the much stronger statement that the conventional theory doesn't hold anywhere, and behavioral finance explains all the phenomena much better. And so basically conventional theory shouldn't even exist. I mean, it should be written off like the theories about phlogiston and about the theory about how flat earth. But currently that's not the situation. So here are some points of comparison. So traditional theory assumes that human behavior is rational.
Sir, phlogiston को अगर थोड़ा सा explain करें.
Phlogiston is a false physics theory that was rejected a long time ago.
इसका economics के अंदर भी
कोई ताल्लुक नहीं. So the traditional theory assumes that people do correct Bayesian in updating, and you have uncertainty, then you get new information, now you have to update the prior information. And so for example, in the cancer example, a priori we know that a woman has 1% chance of having breast cancer. After we observe the experiment, we have to update that probability. Now, once the result of that experiment, of the test is out, so the updating should be done according to Bayes' rule, according to P rational. But as we have seen, people are unable to process this information correctly. And then, of course, once you have all of the probabilities and you have all of the utilities of all of the unknown states, then you make the decision to go for the decision which maximizes your expected utility. That's the traditional theory. Now the behavioral theory says that agents are not fully rational. That's a sort of a fudge. Actually, human behavior is human behavior. Rationality has nothing to do with it. So either people don't have full formation, either they don't process using expected utility, or they don't use Bayesian updating. So these are some of the ways in which rational behavior can fail. So the traditional theory says that everyone is homo economicus, they have only one purpose, which is to maximize wealth. They always make perfectly rational decisions, they have unlimited computing power, they process all possible, in fact they have also all knowledge about everything, even things which are unknown to average people, they are known to this person because we assume full information. Preferences are well described by standard expected utility theory. The behavioral hypothesis says that people are error prone, they make mistakes in calculations, they don't have full information, etc., etc. They make emotional decisions which may not be the right. So Richard Thaler said that the difference between us is that you assume people are as smart as you are, while I assume people are as dumb as I am. Of course, I would say that the traditional economists are the dumbest people in the world, but because they refuse to accept things which are sort of self-evident. Okay, so basically one way to understand the difference between traditional and behavioral is to say that traditional is a normative theory about behavior, which an ideal person who has no emotions and is therefore pure wealth maximizer, has no other concerns, and he has full information about everything and he makes decisions according to the expected utility theory. That is how he should behave. Behavioral theory studies actual human behavior, which is very different. Alright, so this has been noticed for a long time, and one of the objections that the classical people make is that if there are some irrational behaviors, then the rational people will, basically this is the evolutionary argument, that if somebody is behaving irrationally, he will be wiped out. Other people who are rational will profit from this irrationality. So for example, suppose that a stock, people are very emotional and are buying it in excitement, and actually the true value of the stock is not that high. So then the rational person will buy that stock and what will happen? Yes, he will actually sell this stock short. So this means that because he knows that the price of this is going to go down, because it cannot be sustained. So if enough rational people exist in the market, they will collectively drive out the irrational behavior. So initially the behavioral finance people concentrated on this argument, and they have created a large number of models in which they show that this may not happen, that even if you have some hyper-rational people and some irrational people, then the irrational people may not be able to drive out the irrational behavior. So the typical example is that the market can stay irrational for a lot longer than you can arbitrage. So arbitrage basically involves betting that the market will correct itself if there is a irrational mispricing. And what this literature showed was that in order to be able to successfully arbitrage, you need huge amounts of money, which most people don't have. So even if you bet that the market will correct itself, the market might not correct itself, it might become even more mispriced. And so if that is so, then your bet will go wrong and you will become bankrupt before. I mean, even this assumption assumes that in the long run the market will be corrected, but you are not available in the short run. You do not have the time. So if this is so, then this standard argument that the irrational behavior will be wiped out by forces of competition by the rational investors, this doesn't hold. So it means that it is necessary for us to study irrational behavior. Basically, this is the same problem that is occurring all over economics, that the economists are wedded to the assumptions of optimization and equilibrium. And these things don't hold in the real world. This is what makes it possible for you to launch an entirely new way of thinking about economics, because the dominant theory currently being taught all over the world and all over Pakistan, that is strange, that because you see people who have analyzed this have said that in the USA there is a huge amount of investment in these theories. So even though people understand that our theory is wrong, if they have spent their lifetime studying and they have their jobs depends on it and they have students, then they cannot make changes just because of the inertia. But in Pakistan we don't have such an investment. We can launch a revolution. There is something which happened in Japan, which is called I've forgotten the name now. Anyway, what happened was that the Japanese people launched a revolution in steel production, which was called the fourth generation. And the US, all the steel industry was in third generation mode, and it was not possible for them to upgrade all of that. They had millions of dollars invested in the third generation industry. So the Japanese were able to leapfrog, jump over and so similarly it is possible for us here to leapfrog, to jump over them, because they are too deeply invested. They can't move as fast, but we can. So it is possible for us to launch a revolution in economics. So this limits to arbitrage literature basically shows that even if you have hyper-rational people, they will not be able to drive the market towards rationality. And there are many arguments for this. One of them I have described, that the strategy which requires, which drives market may not work. And we will give some examples of that later on. So, one of the advantages of the classical models is that they know in advance how people will behave. Now, when you say that people are going to be irrational, then we have no idea what the behavior will be, because irrational behavior can be anything. And that is exactly one of the classical objections to behavioral finance, that if we give up rationality, then we have opened ourselves to anything. Anybody can say whatever they like about, people behave like this. And so in principle, this is the standard classical objection which is made to the theories of behavioral finance, that then if I'm allowed to explain, if I'm allowed to say anything about human behavior, then I can explain any phenomena very immediately. This person just had a desire to buy at this point, and that's it. So now, whatever it is, whatever the phenomena. So this is wrong because, you see, part of their methodology is that we don't match behavior to behavior, because this is unknown, this is hidden. The human motivation, this is one of the problems with the as-if methodology. They say that we will only look at the observations, we won't look at the whether or not there is a match between motivation, because motivation is hidden, it's unobservable. So now this is a problem, because actually the motivation, the verification and validation of the behavioral comes from checking the motivation. So this is blocked by the traditional approach. As in the last paper, one of the papers, the paper on the John Hayes paper, He said that we were looking at the results of the auction, and then we asked people, what made you do that? And later on, we took transcripts. Did the psychological transcripts. So he said that originally, following economist methodology, we were going to analyze the price behavior, which is the observed data, because that's what you're trying to explain. But later, when we got the tapes, then we realized we spent all our time studying the tapes, because they gave a much clearer guide as to how people were actually thinking. So how people think, how people decide, this is not a black box unknown according as per the assumption of the economist. The economist says that human behavior, because it's unobserved, basically it's the same thing as in revealed preference theory, that we don't know what's inside the heart, so we can only observe the choice. So if you give a person a choice between a mango and an apple, and then we observe, that will give us his preference. You are not allowed as an economist to ask, which one do you like more? So if you say that, if the person says that actually I like mangoes more, but because they have more calories, or because I am allergic, I chose the apple. So this will tell us what his preference was. Preference is not the same as choice. But the economists say that the unobservable preference is not scientific, because it's not scientific to talk about unobservables. So we only talk about the choices. So then again, it is impossible for them to discover the true preferences, so just like that, the economists don't study real behavior, because they say that the motivations is unobservable. So now the thing is that we need to study motivations, and there is some truth to the economist's suspicion that a person might say that I have this motivation when in fact he has some other motivation. So we are human beings, we know all of this, that we know that human beings can try to deceive us in some situations, but we navigate in our society on the basis that yes, we can tell the difference sometimes, and sometimes we will be deceived, sometimes we'll make mistakes. So that's okay, but we can't get by without knowing what is in the hearts of the people. That's how we live. And so basically, the behavioral psychology requires us to study the real hidden motivations. And the economist methodology says that you are not allowed to study real hidden motivations. So that's why there's a huge problem with. That's why economists still do not accept behavioral finance, because it goes against their methodology, even though it's a much better fit. Behavioral finance was the only theory which predicted the occurrence of the global financial crisis. And that's why Taylor has gotten the Nobel Prize, and other people have gotten the Nobel Prizes in behavioral finance, because they have had remarkable success at explaining actual human behavior. But they have not had much success in becoming accepted into the mainstream economic theory. So the paper says that there are two building blocks. One is the psychology. We need to study actual human behavior as opposed to hypothetical, idealized, normative human behavior. The other part is the limits to arbitrage, which means that basically, even if this is the counter to the standard objection, that even if some people are highly rational, and this word rational we should really stop using, because rationality means many things which are unpleasant. First of all, it means that you have full information, you make perfect calculations, and then you only seek to maximize wealth. You don't care about being honest, you don't care about many other things which human beings do. So, but anyway, the only way to get behavioral finance to be acceptable as a topic to talk about was in conventional economics, was to say that even if there are perfectly rational investors, they will not be able to drive the market to rational. Basically, the thing is that what the conventional finance says is that there is the true rational price of a stock, and the stock cannot deviate from this true rational price, because rational people will exploit these deviations. They will arbitrage. If something is more expensive than it ought to be, they'll buy it and sell it to the people at the right price and make a profit from this. So basically what behavioral finance people did was to show that you cannot make a profit from trying to correct mispricing. And we will see examples of that. So these are the two building blocks of behavioral finance. The first one is not too important because basically it's a way of arguing with conventional people. The other one is important. We need to know what is the true behavior, what are the true motivations, and how do people behave in situations of uncertainty where they do not have subjective probabilities. This is something which nobody knows. Prospect theory provides us with a description, but does not provide us with an explanation. So now this is very important. The fundamental value. This is the traditional theory of finance. A security's price equals its fundamental value. So what's the fundamental value? Basically you say that, okay, I have a stock. A stock is like a share in a company. So if the company has 100,000 stocks, then 1 unit is equal to 1 over 100,000 ownership in that company. So now the value of the stock depends on two things. One is that every year there will be some dividend which is paid to the stock owners. So that's my income from that. And then at the end of time there will be a liquidation possibly. So the company will be broken down and be sold off, and there will be some net gain. So that is also added. So basically, assuming the company will go forever, then you have a stream of dividends, which are the payments, and I'm sure that at some point or the other you must have encountered this. So basically the value of the stock is the net present value of the stream of dividends, which is calculated by taking the discount rate and then. So this is the discounted sum of expected future cash flows. In forming expectation, investors correctly process all available information, and discount rate has to come from some utility function about how you value future income as opposed to current income. So the idea that the actual price reflects the fundamental values is the efficient market hypothesis. This is sometimes called the hypothesis that the prices are right, that the prices reflect the fundamentals, the reality. They are not, prices are not governed by irrational behavior. So basically the book by Schiller is called Irrational Exuberance. And this book says how prices are reflect just the enthusiasm of the stockholders without having any counterpart in reality. So that's why it's irrational. So basically these books are in conflict with the efficient markets hypothesis. And as I said, it's really surprising to me, I keep saying it over and over again, how people can maintain efficient market hypothesis in face of massive empirical evidence that this is not true. I mean, it's like holding that there is no wall there, or it's like saying that the sun is not shining, and people, and that's okay, one person can be mad, but to have this be believed widely and to be teaching this to students and the students to be agreeing to this, and this is like a mass hallucination. It's like the magicians of the court of Pharaoh who threw the sticks on the ground and had everybody believe that these are snakes. So this is the current situation. I mean, it's so ridiculous. It's not a subtle mistake. It's not a small mistake. I mean, if you look at the global financial crisis, the prices the prices declined by I think about 50% in the stock market. So were the prices right before the crash or were they right after the crash? I mean, it doesn't make any sense. You can't have both of these things be true. But people do believe, and they have found, it's not that I'm saying this is obvious like the sun, but they have found explanations. So for example, there are ways, very complicated ways that you can explain this thing, and the rational people are working on these explanations still. So in an efficient market there is no free lunch, that is, there is no strategy you can earn excessive returns because the returns automatically reflect all information. So now, as opposed to this, there are many stock market investing strategies. People say, okay, small caps, for example. If the firm is small, then the people don't know very much about it, so the stock could be undervalued. So we go and look and we say, oh, this is a very important stock and it's going to rise, but people don't know about it, so it's time for you to buy this stock and wait for it to rise and you will make profits. Now, according to the efficient markets hypothesis, this cannot ever be true because the price already reflects all possible information about the stock. So if there is information available, if people can rationally predict that this stock is going to rise, then they would have already purchased it and it would have already it would have already increased in price. So somebody has said that the efficient market hypothesis says that if you walk along the sidewalk and you see that there is a $100 bill lying on the sidewalk, then the efficient market person says that this cannot be genuine, because if it was genuine, then somebody else would already have picked it up. So you just go along, because that's the rational behavior says that if there is any profit to be made, somebody else has already made that profit. So there is no free lunch. All right, now I am going to explain how this model is used. Now, you see, the most important, the most difficult problem with this efficient market hypothesis, which nobody mentions, neither the behavioral side nor the other side, is that nobody knows what the dividends are going to be in the future. So, I mean, the value of the stock today is equal to the net present discounted value of the future stream of dividends. But what is this future stream of dividends? Nobody knows. So how can you, this value is based on a mythical quantity which doesn't exist. Nobody has the information to calculate this. So this idea of full information, the person has to know the future in order to be able to calculate this price. So now let's see what happens to a real world person who is trying to follow the rational strategy. So what does he have to do? He says, okay, currently last year the firm paid dividend of $1,000. Now what's going to be the dividend next year? Now a realistic theory would say, okay, let's try to anticipate this. Let's try to calculate. So you have your econometric models, you have many different ways of forecasting the dividend stream. So there is an actual model which tries to realize this. Okay, there is this Gordon model. He says, okay, currently the payment was dividend, and let's calculate some growth rate. So where is this growth rate going to come from? You can find many different ways. You can say, okay, let's look at the growth rate of the economy. You can say, let's look at the past growth rate of this stock. You can say, let's look at the growth rate of the industry in which this stock belongs. So all of these are possible, and you can take many complicated combinations of these. Let's say somewhere or the other we get this growth rate. So then you say, okay, next year the growth, the dividend will be D0 times 1 plus G. The year after that it will be D0 times 1 plus G squared, and so on. So for every time period up to infinity you get growth rates. So immediately we see that the dividend that we need to calculate the fundamental is not known, it is estimated. So as soon as we say it is estimated, then different people can estimate using different rules, different growth rates, and there is no single unique rational behavior. People might have differences about how to calculate the growth rate, and we know in advance that nobody can be right because nobody predicted the global financial crisis. So however we predict the growth rate, there is a possibility of major mistakes. So once we allow for the fact that people don't know the future and cannot forecast it accurately, then the whole expected efficient market hypothesis breaks down. And this argument is so simple. I mean, I just don't understand how any children older than 10 years old can only childish mistake. How can people who make this mistake earn Nobel Prizes? This is really beyond my comprehension. But this is the dominant theory at this time. So here is your dividend stream, d0 times 1 plus g to the t. Now you apply a discount rate, and so let r be your discount rate. So you divide the payment at time t by 1 plus r to the t, and that's your stream of discounted dividends. You add this all up, and that's your current price. This is the theory of efficient markets. The P is the fundamental value of the stock. And by using standard formulas for summing geometric series, which you can ask from Nisa if you don't know, you get that P0 is equal to D0 times 1 plus G over R minus G. The formulas are given in the various places. So basically the discount rate has to be greater than the growth rate. Otherwise, you have a positive payment every period and you take an infinite sum, you will get infinite value. And so that's not going to give you a finite value of the stock. So you have to discount at some value higher than the growth rate. So R minus G has to be positive. So this is the fundamental value, but it's purely imaginary. It's just an act of imagination. It is not something that exists in the real world. You don't know what the growth rate is and what is discount rate. Nobody knows. I mean, it's how I value future relative to today. This may vary from person to person, and within one person it may vary from time to time. I may take a long run view at some points of time. I may be very, and in some other points I may be very short run. And we all make these fluctuate, and that's what being emotional means. That suddenly I look at this cake and I'm on a very big diet, and I know that I want to actually reduce my weight, but I can't resist the temptation. So I go for the short run gain, and I sacrifice the long run goal. So we are all like that. So it's not possible. The discount rate cannot really be determined. So there is no accounting for uncertainty. Now there is one concept, that is uncertainty and risk. So the risk is when you can calculate all the probabilities of all the events. Uncertainty is when you don't know the probabilities. So this uncertainty is not admitted by economists because they say rational behavior involves changing uncertainty into risk. Again, this is a wrong argument, and I have explained why economists believe this idiotic thing, and in other places. There is another concept which is developed by Nicholas Nassim Taleb, very important concept. This is something that you can use in your theses, the concept of the black swan. So then event occurs which is completely unexpected and unpredictable. So the black swan name comes from the fact that in the positivist philosophy they said that there are two types of truths. There are analytic truths, and analytic truth is something like 2 plus 2 equals 4 or Pythagorean theorem, which you can prove purely by logic. It doesn't involve looking at the real world. And then they said there's another type of truth which is called the synthetic truth. And synthetic truth you get by looking at the world. So for example, the synthetic truth is all swans are white, because Europeans had only seen white swans up to that time. So then when they went to Australia, they found a species of swan which was black. And so suddenly, and this was completely unexpected because the complete experience is like, if we say that every day we see sunrise, and this has happened for thousands of years, so predict that tomorrow there will be sunrise. But tomorrow if the sun goes nova, then that's a black swan. It doesn't have any match to our past experience. So similarly, this black swan had no match to the past experience, and yet this swan was a genuine swan in the sense that it could interbreed with white swans. So unexpected things can happen. That's the black swan. So once you understand that, then actually Nicholas Nassim Taleb was actually a stock market broker. And he said that, you see, if you anticipate what's going to happen, if you think that you can predict everything, then you will invest in a different way. But if you think anything might happen, then your investment strategy will be very different. Today, you see, today in econometrics, we are teaching these arch-garch models. These are exactly the idea that I can predict the volatility. So this denies the existence of the black swan. Now again, it is surprising. Why are you denying existence of black swans when the global financial crisis happened? And it was a black swan. So the surprising thing is that these arch-garch models are being used today to predict the volatility of the stock markets. And what Nicholas Nassim Taleb says is that, these models work fine in regular times, but if you calculate the impact of the black swan, it completely overwhelms. So the defense for the arch-garch models is that, yes, in normal times they work. But what Nicholas Nassim Taleb says is that he studied, for example, in 1980s, there was a financial crisis in the savings and loan banks in the USA. So he says that in this one crisis, the loss that was made in billions of dollars wiped out 80 years of earnings in the banking industry. So this one incident which you couldn't anticipate really overwhelmed. So instead of trying to predict these little itty-bitty changes, you should look at... So he starts the book by saying that, in Las Vegas, the casinos, they calculate the uncertainty from the roulette wheels, because what happens is that as you use the roulette wheel for a long time, it might become uncalibrated. You have to have exactly 1/32 probability. So suppose one of the slots becomes more weighted, more than 1/32, then people who bet on that would be able to make a profit. So these are very minor things, and it requires huge amounts of... So he said that, in Las Vegas casino, what happened was that one of the lion trainers who had raised the lion from childhood, he had this act in which he would put his head into the mouth of the lion, and the lion bit it off. He was angry that day. So the loss that occurred to the casino was in millions of dollars, and this was a black swan event. So basically, instead of trying to calculate these itty-bitty minor deviations, which is what we do with arch-garch, you have to expect the unexpected, and there are strategies for doing that, but they involve very different types of mindset. Now, actually, So Keynes was aware of this, and he said that instead of what is the value of stock? So he gave the example of the beauty contest. He says that in the beauty contest, if you want to predict the winner, then it is not your judgment that matters. What you have to do is to ask how the judges are going to judge. So just like that, the stock, you pick the one that will appreciate is not the one that has the strongest fundamentals, it is the one which the public will think is going to succeed. So if there is a news today that the bitcoins are going to rise, then that is going to govern the Bitcoin, not the fundamental value, which is zero. So remember the dot-com scandal, collapse, that was driven by the fact that the smart people didn't know what's happening in the dot-com market, but they knew that everybody thinks that this is a coming stock. So so then they speculated that they bet on not on the fundamental values but on the public, and this is exactly what Keynes said, that the value of stocks doesn't depend on the fundamental; it depends on what people think is the value of the stock, which may have nothing to do with the fundamentals. He says, despite this, as long as everybody follows standard rules of behavior, there will be some stability in the stock market, because people behave today the same as they behaved yesterday, for the most part. So the efficient markets hypothesis we are discussing this only to explain conventional theory, which you need to know. And so in conventional theory and not reality. So in the conventional theory, there is a large number of rational profit maximizing investors who have full information about everything, and they make their living by analyzing, valuing and trading securities. These are competitive markets. Nobody can actually make the market as people are actually doing, that drive the market up by buying, or actually what happens has been reported, and these are the things for which people have been fined and jailed, is that the big companies, they start selling the stock and in an attempt to create panic, and they spread the news that this company is collapsing and everybody should sell. So when everybody starts selling, then the stock starts going down, and they know this, and so quietly they have sold the stock at a high price to create a panic, and now they start buying back these stocks, and at the end of the day the stock is right back where it started from, but they have made a huge profit off of the small investors who don't know what's happening. So this kind of thing is not supposed to be happening in a rational market. Nobody has enough power in the market to create. So basically rational markets depends on making ridiculous assumptions as usual. Information is costless and widely available at the same time. Information arrives randomly. Investors react quickly and fully. So this is the theory. This theory has nothing to do with reality, but this is the theory which is taught all over the world. Now, just to put you in the picture in terms of being able to understand the conventional theory, there are three forms of the efficient market hypothesis. The weak form, in which says that basically the prices reflect all the publicly available data. Nobody can make profits on stocks. This is the weak form. So basically it means that the return tomorrow, the return on the stock is uncorrelated with the past sequence of prices. So that's something which you can test, and actually it seems to be fairly correct on the average. And if you look at the gain on a stock over one day and ask for a correlation between this gain and the gain yesterday, you find the correlation is zero. It means that you cannot predict what will happen tomorrow by learning what has happened yesterday. So if you look at the price yesterday and the price today, and you say, oh, this stock gained, so it's going to go up more, and so you play that strategy, you will not make any gains. And in fact, you can look at any strategy which looks at all the prices over the past year and say, okay, I will look for this kind of pattern in the stock prices and I will use this to make forecasts. So none of the strategies will work because there is no correlation. So this is the weak form. The semi-strong forms is that the publicly available information is fully reflected in securities. So now you go beyond the prices. You say, let's look at the stock market reports. I will take the companies. So in the prices, you only have anonymity. You have the time series of the prices of the stocks, and that's all, and the dividend streams, of course. Now you say, I go beyond the publicly available data. I will go and get the stock market report, and I'll see, oh, the Firestone company has posted a loss in the last quarter, and the loss is not fully reflected in the prices. So if I use this information, I can make a profit. So now the semi-strong form says that even that information is reflected in the prices because this information is publicly available. Somebody the other has read that report and has made the purchases, and so the stock market cannot have that information. So then again, you can test this by looking at the release of the company report and seeing if that is captured. So you look at all the companies which report loss and all the companies which report profit, and you ask, is that gain already, when the report is published, is that gain either immediately used on that day, or is it true that the companies which reported profit, their stock appreciates over the next quarter, for example? If their stock appreciates over the next quarter, then the semi-strong hypothesis is false because it was not immediately incorporated. Either the stock market jumps on that day, that means that the public information was immediately captured, and then from then on there's no change, or it may be that information, the public information, has already been incorporated, so there is no change because before the stock market report was published, people had that information and they utilized it and they made their profits. And then the strong form says that all information, public or private, is fully reflected. So even if somebody has private information which is not known to anybody, he will utilize it, and so that information will be available to somebody else who has already foreseen it. So these are the three forms of the efficient market hypothesis. So in this page they explain how you can test the three forms, and I've already explained it, so I will go forward. So I will Alright, so that's the end of the explanation of the first part, which explains basically the theories of efficient markets. Now we come to the behavioral finance theory. And the first part of this is the limits to arbitrage, which explains how if some traders are rational and some are irrational, meaning that some people have full information about fundamental values but others don't, then according to the efficient market hypothesis, the people who know the fundamentals will be able to control the market and will drive the prices to the fundamental values. And so this argument is used by economists to say that even if there are irrational traders, they will not influence the price. There are two mistakes in this argument. One is that the idea that the equilibrium is achieved instantaneously, and the other mistake is that how does this equilibrium occur, even if it's not attained instantaneously. So if you study this equilibrium process, and that is what the behavioralists have done, they find that even if you have very efficient, fully informed traders who know the future perfectly, it is possible that they will not be able to drive the market to efficiency for many different reasons. So the behavioral finance argues that the traders who are not fully rational cause deviations from the fundamental value. Now, I would like to understand that even this objection of the behavioral finance people is not a correct objection. It is an objection which is based on assuming that yes, you are right. I mean, it concedes the default to the efficient markets hypothesis. Yes, in absence of any distortions, this would be the correct theory, but there are some people who are irrational and they are causing deviations from the fundamental value. Now, that's taking the efficient market hypothesis as the dominant theory. If we just discard this, that okay, fundamental values have nothing to do with stock values, which is the correct theory, then you wouldn't formulate that it is irrational behavior which causes deviations from fundamental value. You would say all people are irrational because nobody can be rational. So now once you start from this as your default, then you are not faced with the problem of explaining why stocks deviate from fundamental. That's not a problem because fundamental value is undefined. So we start in a different place if you don't. But the behavioral economists, because they have to argue, because they are small fish in a pool which is dominated by sharks which advocate efficient markets. So they say, okay, allow us a little bit of space and we'll say that our people are irrational and they cause a little bit of deviation. So at least that much you have to admit. So this argument is distorted by the existence of the efficient market hypothesis. The real argument is elsewhere. The real argument is that nobody can ever be rational in the sense that people ask for rationality. That is knowing, even the Gordon model shows how rationality cannot exist, because the information that we need for so-called rational behavior, nobody in the economy ever has. So then we have to come up with an entirely new theory. How do people price stocks given that that information about fundamental values is not available? Then we can start to talk about a realistic theory. And now what happens really is that different people have different types of information and they will use this in different ways. So there is a lot of heterogeneity and noise which we don't know about. So we have to study that. We have to study how people actually process information as opposed to making theories about rational processing of information. And since the efficient market people are dominating, so these kind of theories are not done. Those people who do those theories can't get these papers published because they say, oh, that's not rational behavior, so it's not acceptable. So you see, this whole paragraph, this is a defense that here we are proposing that prices may deviate from fundamental values because of irrational behavior. So the EMH people say that no, even that cannot happen. Even if some people are irrational, they will be driven out of the market by the rational people. So to counter this objection, they say no, this may not always happen. And that's called the limits to arbitrage. That even if a lot of rational people are there and they know exactly the fundamental values and they are trying to drive the market to fundamental, even they may not succeed. So we look at this. So as soon as there's a mispricing, an attractive investment opportunity is created. Oh, the price, the stock, the .com security are trading at $200 and the real value is only $50. So let me short this security. So short sale is, you say that 1 year from now I will sell you this security at $50. So this is called a short sale. You don't have any of this security. So the people who think that the value 1 year from now will be 200, they will eagerly buy from you because 1 year from now they will be able to buy this security at $50 from you when the price is actually 200, so they will make $150. They will make a killing, but you will make a profit if the stock price declines to $25. Then you will make a killing. So short sale is betting that the stock market will decline. So now behavioral finance theory is even if the asset is wildly mispriced, so a stock which is worth only $10 is selling for $300, which is what happened in dot-com bubble, you cannot profit from this. So the idea that the rational trader can go in and take a profit, and this act of taking profits, you see, when you short the profit, you signal to the market that the stock is going to go down, and if there are enough people who are shorting, this will cause the market to go down. So he says that suppose that you are trying to do that, then the attempt to do so is both risky and costly. So it's not that you are guaranteed. After all, if irrational behavior can occur for a while, and that's why we are thinking about this, then it can occur for a while longer. So because it's risky and costly, even somebody who knows that this stock is wildly overvalued, there may not exist any way that he can profit from this information. This is the key contention of the behavioral economists. So irrational traders are known as noise traders because basically there's the fundamental value which is flat, and then there's noise which is random fluctuations. And so if somebody tries to profit from the noise, that's called noise trading. And rational traders are called the arbitrageurs. They benefit from deviations from the fundamental price. So arbitrage is, strictly speaking, a riskless strategy which gives you profits at no cost. So behavioral finance argues that this is not true. Even when you have noise trading, there are no arbitrage or opportunities created by this mispricing. So this argument is more complex on both sides than I am explaining to you. So one of the basic things is that if the prices are correct, then there is no free lunch because no price is wrong, so you cannot benefit. But the reverse is not true. There are many situations in which there is no way to take an advantage of the mispricing. So there is no free lunch, nothing you can, no quick certain profits, but there is mispricing. So the problem with the conventional efficient market hypothesis is that they take these two things to be synonymous. Now, it is actually true that there is no free lunch in the following sense, that there are lots of very smart people who are looking at all possible data on the stock markets and they're trying very hard to take advantage. So if someone uninformed goes in there and he tries to bid on the market and tries to make a profit from this, he's going to get creamed. That is, in fact, today what is happening is that there are these electronic traders and computers. They are making transactions in microseconds. So this can happen, and apparently it actually does happen, that you go in and you put in a bid to buy a stock, and because your bid is slightly disequilibrium and the stock fluctuates, so this in microseconds before you, so you are going to take 1 minute to between the time your bid is placed and the time that the order is executed. So these computers are watching that 1 minute lag, and in this 1 minute they will buy that stock and sell it to you for a profit. So it's really this is not hedging. This is not hedging at all. Hedging we will discuss later. This is just that the stock market is fluctuating. So as soon as it goes below the price at which you have placed your bid, say they will purchase the stock in the split second, and then they will sell it back to you in the next split second. So they will benefit from your bid. So there are no free lunches for the average uninformed investor, but this no free lunch comes from the fact that there are lots of people who are looking at opportunities, and if you come up with something which they haven't thought of, then you can make free lunches. So there are no easy free lunches, is what you can say. And if you run basic regressions and you see that, okay, so everybody has run all these basic regressions. So if you want to say, okay, I will follow a rule that if a stock goes up by 10%, then it means it's going to go up further. So there are no simple rules like that, because all simple rules have already been analyzed to death by very sophisticated programs, and if there was any profit in them, they would already have been exploited. So it is certainly true to that extent. But this doesn't mean that there is no mispricing. A lot of mispricing can exist, but it might be impossible to take advantage of that mispricing. So it is true that there is no free lunch, but it is not true that all the prices are correct. And what the efficient markets people think is that these two are the same, but they are not. So this is an example of how the fundamental trade goes. So basically this is done by hedging. This is what Friedman says, that suppose that the fundamental value of the share is $20, but some people are pessimistic and they start selling this share and the share is trading to $15. So now technically you can buy this and wait for it to go up to 20. But this is not so good. So what they do, what they say is, okay, so if you just buy the Ford stock and wait for it to go up to 20, there are lots of risks involved. So what they do is they say that let's buy a hedge. You make a hedged investment. You buy this stock at $15 and the other stock you short. So you bet that this stock will go back up to $20 in 1 year, and so you sell it for so you buy the stock today and you hope that it will go up to $20 in 1 year, but there is a risk that, okay, maybe it will not happen in a year, maybe within a year. So what you do is you buy another security which is a substitute, which has very similar returns. So for example, it is suggested that you buy General Motors, but instead of buying it, you short it. So 1 year from now, you sell it at the same price that you expect for your Ford stock. So now you are planning to sell one stock of General Motors for $20, and you are committed to, and you already have a stock of Ford for $15. So now suppose that for some reason the stock of Ford doesn't go up to $20. It only goes up to 18, or maybe it's even at 12. So then because you have shorted the other stock, your risk is covered. If the two stocks behave in exactly the same way, then because you have sold one and you have purchased one, your risk is completely covered, and the only thing which can happen is that you will make a profit if the mispricing is corrected. If the gap remains exactly $5 between General Motors and Ford, then your purchase and your sale will cover each other, cancel each other, and you will have no risk. If the gap increases, you will have a loss, and if the gap decreases, you will make a profit. So now you are betting on the gap to decrease. So now, if assuming that your theory of fundamentals is correct, then as long as the gap doesn't increase in 1 year, you will make a profit. But if the gap increases, you will make a loss. So basically, it's sort of a covered bet. Now, the thing is that if a lot of people do this, then this will automatically fix the problem, because the as people keep buying the stock, it will raise the price, and so it will become a self-fulfilling prophecy. So if there are a lot of rational traders, and if they can all compute the fundamental value, and if they can all see that this is mispriced, then they will cause the stock price to rise by doing this kind of trade, and so the mispricing will be eliminated. Now there is a problem of common knowledge, which is also a problem, we will see. The assumption that everybody knows exactly the dividends, so everybody can calculate exactly the correct fundamental value, so everybody can tell that this stock is undervalued, so everybody will buy that stock, and so the stock price will increase. Now suppose there is no common knowledge, suppose that some people have knowledge that this is mispriced, quote unquote knowledge, according to fundamental values, but most people believe differently, then their purchase will not create any pressure on the stock. So that is the problem, and this has actually happened. This is a famous book called When Genius Failed, which I have, and you might find it very interesting reading. I will send it to you. This is when two Nobel Prize winners, Myron Scholes and Merton, created the Scholes-Merton theory of derivative pricing, Merton-Scholes formula, and they noticed that there was they received the 1997 Nobel Prize for a new method to determine the derivatives. They created this management firm to try out these new theories which none of the experienced stock market brokers were using, because they were aware of the possibility of the black swans. So normal investors don't use mathematical formula to calculate, but these people said no, we can calculate everything, and they did. And so for a while what they did, exactly this hedging strategy. They would buy a stock which is mispriced, and they would buy the opposite stock and short it, and they would bet on the gap to decrease. Now usually in these cases of mispricing, the gap is very small. So one of the things they did in order to so the profits are very low. So one of the things they did was called leveraging. They would use $100 to buy $1,000 worth of stock, and you can do that by using the stock itself as a security against your. So you borrow $100, and you borrow $1,000, and you say that if the stock goes down, you can just sell the stock and get your money back. So there is no risk for you to sell me $1,000 if I have $100 of capital of my own. So what happens is that if the stock increases, then the value of the security has increased. If the stock decreases by 1% or 10%, then you get what is called a margin call, that your cash position has been liquidated. Now either you put in more cash or you sell the stock and pay off the loan. So by using this strategy, which is very risky, then you can buy $1,000 worth of stock for $100, 10 to 1. And so that's what they did. They used millions of dollars to buy billions of dollars worth of stock, so that, you see, what happens is that suppose the stock goes up by 10%. So from $1,000 it goes to $1,100. So by this margin trading, you have made 100% profit, which is very different from 10% profit. So leveraging gives you huge profits. So that's how you can use very small changes and make very huge profits, and they did successfully with returns up to 21%, which was much higher than anybody else was doing. But as some stock traders warned them that you are playing a very, very risky strategy. We don't do this because there's huge risks. As somebody, in fact, there's a conversation reported in this book by Scholes. So conversation is that these people said, the managers of the long-term capital management, that look, there are little nickels and dimes lying around which nobody is picking up, so we are going and picking them up. He says, yes, you are picking up these lines on that road, but you don't understand that there is a steamroller coming and as you pick up these dimes, you will be flattened, and that's exactly what happened to them. that there was a huge collapse with losses around $5 billion, and it was because they had borrowed immensely. This actually caused a crisis in the entire market, and the Federal Reserve had to come in and create a deal and bail out people, and it was a very mess. If they had not bailed them out, then the whole market, stock market entire, would have collapsed. So basically at that time Merrill Lynch observed that mathematical risk models may provide a greater sense of security than warranted, and therefore reliance on these models should be limited. This is exactly about Aaj-Gaaj. It gives you a false sense of security. Yes, I can calculate the risk. So if the risk is 90%, now a calculated risk is different from a incalculable risk, which is the uncertainty, which is the black swan, which was neglected then and is neglected today. Even today, people are getting theses using Aaj-Gaaj.